Recording is running, and I want to thank everybody for coming here today. And wanted to share some things that I've learned across the years from pro traders who seem to have their stuff together. And many of our customers now, and many of you out there, are attempting to qualify for a combine, a top step trader combine, where another company, a third entity, will fully fund a trading account for you. And when I first heard of this concept, I honestly wasn't very certain about it, and kind of poo-pooed it, since I'm being honest with you, and thought there's no way this would last. And as it turns out, more and more and more of our customers are attempting to qualifying for this fully funded live account. And then a lot of you are struggling with it. And I figured if you're going after it, let me share what I know with you about some things that I've learned from people who are pro traders that have something most people don't know about. And so without a further ado, I'm going to turn off this dumb camera and draw on my screen a little bit for you. Okay, so one of the problems, one of the worst problems with traders, let's call it a predetermined mentality. When I find people and they find us, by the time I've found a new customer, most of the people have been around 3 to 5 years, and they've been to all sorts of webinars. And so one of the biggest myths that causes the largest problems with people being successful is the idea that's sort of perpetrated by, I would honestly say, I think it's higher than this, 90% of vendors and educators that you meet, they create this idea that every equity curve in the world, every system that they sell, does this. And this is sort of profit over time. And I think one of the biggest obstacles that you'll have to qualifying for a combine or maintaining a profitable trading account is this weird-ass idea that no one ever loses. Okay? How many of you would agree with that statement? This idea that for year after year after year, you're sort of chasing this performance curve, and every vendor that ever sold a piece of software wants you to believe that their system only ever just goes up and up and up. Okay? Now, when some of you are kind of on the other side of this mental curve where you say, yes, that is possible, and then most of you that have survived long enough to understand why this is real, most of you, I think, would agree that this isn't a reality. It's a unicorn. It's a leprechaun. But when you first start trading, there's this idea, there's this hope that's perpetrated that you never have a losing day. You never have a losing month. $100 a day, you start with one contract, then you go to 2, then you go to 3, then you go to 4, then you're making $1,000 a day, and we go, yeah, yeah. So I want to demonstrate something to you really quickly, and I'll get everybody a copy of this spreadsheet when we're done. One day I paid my kids some money, and I paid them some money to do a test for me. And so let's kind of zoom out here real quick. What I said was, hey, I've got a bag filled with marbles. And Clint, I had a bunch of white marbles and a bunch of blue marbles. And what I did was I filled the bag up, and I want to say like 60% of the marbles were white and 40% of the marbles were blue. And I told my kids, I want you to pick the marbles out of the bag until the bag is empty, and then keep track on a spreadsheet what you get. And so they did that, and I assigned a positive $100 value to the white marbles, and then I assigned a negative $100 value to the blue marbles, because the customers that I met generally fell into one of two different categories, and you'll sort of know which category you're in when I describe this to you. The first group were counter-trend traders. They had a risk-reward of 1-to-1. So if they risked 10 ticks, they made 10 ticks or 9 ticks. It was pretty much symmetrical on risk. And then their results were sort of 60-40. I had one customer whose results were 69% profitable, and he was all over it. He'd spent a year trying to get to 70% and he couldn't do it. And so, yeah, Clancy, exactly. I said, I'm going to try to duplicate what most people start out trying to do. And most people, when you first see a trading system, it's a counter-trend system where somebody is calling tops and bottoms. And that's very hard to learn. It's almost impossible, I think, when you first start trading to master that. And if you're in a trending market like the one we've been in, it's sort of a suicide mission, if you ask me. And so I wanted to emulate that, because if this is what people were trying to trade, then I wanted to see statistically what we were looking at. And so over here, you'll see that I had the kids pull the marbles 5 times in a row. And so they emptied the bag, they put it back in, and they had 5 pulls. They had 5 pulls of marbles. And you can see here 74 at the bottom, 5 at the top. So there were 70 marbles in the bag. And I started to see some patterns that vendors don't talk about when they teach their system. And Clancy, everywhere you see red was a losing trade. Okay? And everywhere you see a white box in these columns was a winning trade. And so when you see these signals, there's a few things that you'll notice right away with regards to any model that you trade. Clancy, there's losers in there. In fact, there's a bunch of losers in here. And one of the first lessons that I want you to learn is that when you're doing backtesting, you're essentially experiencing the model in advance. And one of the things that you can learn from backtesting is maximum number of losers and maximum number of winners. Now, what do you think that does for you psychologically, Ray? Carrie, what do you think that does psychologically? Okay. A perfunctory examination of my marble test shows how many losers can you expect reasonably in a row before a winner comes. Well, I was hard-pressed to find more than 3 in a row. And this was about as random of a sampling as you can get. And so looking at this model with a 60%, 40% win rate, 1-to-1 risk reward, I know going into it that I shouldn't see more than 3 losers in a row. So Carrie, after 350 pulls of a 60-40 system, what could we say in terms of establishing a trading system or a trading plan for a company like Top Step Trader? we could say, hey, if we have a max consecutive losers number, let's say it's 5. Okay, worst case scenario. Or we'll stick with what we've got. Well, 3. What if you multiplied that by 50%? When could you stop your day theoretically? And we're working our way from the most basic concepts to the most enigmatic, the ones that are a little more detailed. Well, we could say, hey, if I see 4 to 5 losers in a row, that essentially says the environment my model needs to succeed is gone. The market conditions required for my model to succeed is wrong. It's gone. It disappeared. It evaporated. Okay? What it also does is it sets an expectation, which means in your trading plan, I'm going to trade 3 losers in a row through. I'm going to trade 3 losers in a row completely through, and possibly a 4th, to take advantage of the statistical behavior of my trading plan, of my model that I'm using. Because, well, we'll go into that in a second. So that's the first thing I want to talk about. Now, the second thing that I learned, I pulled these 5 different graphs, okay? And I graphed all of the results with this marble test. And in a minute, we'll look at some real back testing for some trading systems that we went through. And let me zoom this in to 200%. Okay. The second thing that I want to tell you today regards equity curve DNA, the anatomy of an equity curve. And I've worked with so many traders at this point, I've lost count. And if I have any credentials, it's that I've worked with traders all over the world and seen what they've done. And so an equity curve, before you ever place a trade for a combine or for your personal account, you need to have a realistic expectation about the statistics of equity curves. And there are 3 phases in every curve. I don't care who you are, if you are the worst trader in the world or the best trader in the world. There are 3 phases in every curve. Sort of like if you're a human being, you have a heart, you have a lung, you have a kidney. You need these things to qualify to live. Understanding these 3 phases in equity curves prepares you to take advantage of the holy grail money management technique I'm about to teach you. Number 1, every equity curve has a growth phase. Duh. But did you know there are 2 other phases in every trading plan? Every equity curve for every model I've ever seen. Does anyone know what the 2 other phases are? Unavoidable, will come, can't avoid them, gonna see them, no way, no how. Bill got the first one, the drawdown phase. Leonard got the third one, the plateau, or the consolidation phase. No one talks about these, because to talk about those, Nick, implies that your model that you're teaching, your system that you're perpetrating, you're attempting to make money selling, has one. And if I lose, then the guy over here who says he never loses is going to get all my sales. And so, Leonard, one of the dirty little secrets of the trading industry, if you're a vendor, is to never, ever, 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 ever talk about drawdowns. And if someone has one, Bill, whose fault is it? Is it my fault as a vendor, or is it your fault? Who did something wrong? And then they deploy something. Shame. Well, Bill, you must have done something wrong. So here's the wonderful thing. Here's the wonderful part of today. We're going to not only embrace drawdown, we're going to leverage drawdown. Did you know that you can use drawdowns, the component of an equity curve, to your advantage? I'll tell you how in here in a minute. Number 3 is the worst one. Number 3 is the one I believe people lose their accounts over. Every equity curve has a plateau phase. So let me show you what I mean by that. We'll give you a couple different examples. If I look on this chart real quick, and I don't want to spend too much time here, but this is important. This is a drawdown. A drawdown is simply that. It's a pullback in the direction. But when you get to a plateau phase, George, it means you're where you started a while ago. So from trade number 10 to trade number 30, after 20 trades, you're exactly where you started. From trade number 40 to trade number 57, you're exactly where you started. Now, George, on paper, when you see this equity curve, does it feel good? Is this a model that you would trade? Let me ask everybody this question. If I told you this was an auto trading strategy, and all you had to do was turn it on, and after 75 trades, you would make, after commissions, $2,700. Would you turn to your broker, your equity manager, and say, yeah, put me in that fund? Yeah. Now here's the thing I know. 90% of new traders won't survive this. 90% of new traders won't ever make it through this. And Clancy, they will leave this trading system and go to the next hot guy, the next email in their inbox. You're going to win, 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 win. It's not the drawdown that kills accounts. It's the plateau phase that kills traders. But a plateau phase is unavoidable. Look, watch. Here's one of the bags of marbles that was pulled. Can everyone see the plateau phases here? This is a 60-40 chance of success, 1-to-1 risk reward. And here's the reality. From trade 30 to trade 50, 20 trades in a row, Ray, you haven't made any money. Now, small rabbit trail. One of the obstacles to you getting a fully funded account or succeeding as a trader stems from the Puritan work ethic. Did you know that? Did you know we can blame pilgrims for your failure? We can blame them for a lot of things, but we'll start with that. And Clancy, here's what I know. This is what people say to me when I show them the plateau phase and the drawdown phase. If I'm sitting here, I better be getting what? If I'm sitting here, I better be getting what? Paid. If you're American, if I'm sitting my ass in this chair, I better be making money every minute that I'm here because I got $15.26 per hour at my last job. And Earl, what do the professional traders say? Is that true? If I sat here 8 hours and the market was horrible and I'm down $200, it was a great day. And so one of the reasons the plateau phase is so antagonistic and an obstacle, a monumental obstacle to getting a fully funded account with anyone, your own or through a top step environment, is understanding that this is coming. This is why traders who put the most pressure on themselves fail. If you're out of work and you have to earn a living trading, and it's the first time you've gone out on that limb, I would short you $1,000. I would short you because I've seen so many. Michael, I just lost my job. I have 2 kids in college. I just put all of my wife's inheritance money into a Ninja Trader account. I have to make $1,500 a week or I'm not going to be in good shape in a couple weeks. You're going to fail because you have to understand the plateau is coming. It's there. Look at the other examples of these graphs. Can everyone see the plateau phases? Can everyone see where the system would get dropped? These are all the same marbles, by the way. These are the same 70 marbles in the bag. They just come out at different points randomly. And these are the things you need to keep in mind when you start to trade, when you backtest your model. You need to understand, number 2, how long will my plateau phase last? And what have we seen so far? 50 to 66. There's 16. Up here it was about 10 trades, right? Over here it was a little longer. And we're getting a feel from our analysis. Here's 12 to 33. So Carrie, one of the things we would know about this model, other than the 60-40, other than the max number of losers and winners, is right now that the plateau phase, the PP, is somewhere between 50 and 20 trades. So George, looking at the statistics of this, can you see what I'm doing just very simply, very basically? I'm measuring how long the market stayed in a plateau phase before it grew. And George, can you see here that on average it's taking about the same amount of time before it puts in a new equity high? Here we go, 10 to 30, 40 to 60. So let me ask you a question. If you knew after 350 backtests, Carrie, that the plateau phase lasts about 20 trades, Catrice, Han, what might you do at trade 15? What might we do at trade 16 or 17 in a plateau phase? Think like a mathematician. Remember that part of school we all fell asleep during? The room was really warm. Right in here, yeah. This might be a place to go from 1 contract or 1 lot to 2. Because, George, it's getting ready to go up. And so when it explodes out, instead of being at 1,500, you could be at 2,200 in the growth phase. So there are things that you can leverage, and I just want to encourage some new thoughts here today. I want to encourage some new thoughts because a lot of you have never been told to think that way. So trade 30, we're not really putting in new equity highs. We start getting closer to trade 50. That's 20, George, right? Right around here, I'm going from 1 contract to 2 contracts. And then off we go. Okay. Now, let's talk about the drawdown. Let's talk about drawdowns. When you look at this model really quickly, and we have a bunch of curves that we can look at. George, look, I want you to see that I can measure from $1,590 to $1,250. So $600 to $250. It's a $350 drawdown max that I can see here. And then Carrie, over here, look. $1,790 to $1,340 is $450. So the max drawdown here was $450. Over here it was $400. This is an informal Monte Carlo analysis. $2,280 to $1,800 was $480. Do you guys notice, do you ladies notice a trend here? On average, the drawdown was somewhere between $400 and $480 over 350 back tests. Now, one of the things that I've learned from the guys who've been doing this for a while, the ladies who are crushing it and making money, is this is a key. This is a key to having a profitable account. So if you were going to apply for a combine with Top Step, if you were going to apply for a combine, one of the things that I've learned about these companies is they have a high watermark and a low watermark. So Carrie, that means you're starting out neutral right here. And Carrie, if you hit a certain size drawdown, you're out. Right? But if you hit a certain peak in your growth phase, you get a fully funded account. So nobody really has any problems with the idea of making money. But psychologically, the odds are so stacked against you in the down phase, in the drawdown, in the plateau. That's where people's hopes and dreams are squashed, because no one's ever taught you about this. There are kids today who were never taught how to balance a checkbook. They were never taught how to pay a bill. And they leave college and they default on everything. They overdraw. They just weren't told. This is the real world. Well, how can we leverage this piece of information from the math to make this less likely? How can we leverage this information to make being expelled from your combine less likely? Well, here we go. Ready? If I know the average drawdown is $450, I won't start trading live until the model is down $400, let's say $350 from its last peak. If I know that the average drawdown is $480, where do most traders start trading their model live, Clancy? Where do you guys, what does almost every trader do when they're watching a pro room? They see this, right? And Clancy, they start trading live right here. This thing is on fire. I can't wait. And what happens, Carrie, right after they start trading live right there? they hit the drawdown. I met a guy, he was 180 years old in Florida. He had 200 auto traders that he had custom written by some obscure Russian programmer. The guy was the bomb. He made money. I know people. I spoke to people that had made money with him, and he said, Michael, do you know the best time to join a trading room? And I said, no, when? He said, when everyone is canceling their subscriptions. I said, huh. He said, do you know when I pull my auto traders offline? I said, when? He said, when they're really hot, when they haven't had a pullback. And that's when I start putting in other auto strategies that normally don't do well when the others are doing well. And this was my first exposure to this concept. If you know what your average drawdown is for your back-tested model, then you know that at one point drawdown does not last forever. So Clancy, you become a drawdown hunter. And I start, if this is my $450, Carrie, start placing your combine trades here. Start entering your trading model here, because when you start to earn money on the reversal, it's the bank's money. It's other people's money. And it's easier psychologically to lose that money if there is a drawdown, because it's not yours. So if you come back and look at any of these examples that we were looking at, I know there's a $400 drawdown, and I'm sitting here. The worst thing, again, the Puritan ethic is, man, it's just going, and I'm going to put my Top Step Combine live. Don't do that. Measure your peak, and now look for it to come down your $400. Here is where you start telling Top Step what your model is. Here is when you start to enter. You're avoiding as much risk as you can. So I would say, as a rough figure, look for 75% of your max drawdown on a pullback. And then from here on in, it's the bank's money. And you don't have that psychological weight on top of you, right? Okay, so does everybody understand that at this point? Because here's where things get a little weird. Here's where things get a little weird. Here are the two secrets that I want to tell you about. There are two methods to prevent ever hitting your low water mark with Top Step. There are two techniques that no one teaches that, if you hear what I'm saying, will make you a rock star in the peer world of trading. Okay, and at the end of this, I'm going to give you a link to click on so I can send you the book that teaches this. Again, no charge, no money changes hands. I want you to have this. Method number one, max drawdown exercise. Okay, when you backtest, there's something called a margin of error. If you have less than 100 backtested examples, your margin of error is somewhere between 10 and 15%. If you backtest and you're somewhere in the 400 to 500 range, your margin of error decreases somewhere to 5 to 6%. So if you use this exercise, it's important that you leverage the statistics. And I'd like you to get as many backtests as you can to be able to leverage what I'm about to show you here today. Okay, and if you don't know what backtesting is, if you don't have a rules-based strategy, if you don't have a trading system where you can say, this is my entry, this is my exit, this is where I get in, this is my break-even component, then you shouldn't be doing this at all. Write me an email and we'll talk. But if you have a setup or a system or a methodology, follow me. When you have this system, you're going to look at max drawdown. You're going to look at your max drawdown. Let's say that max drawdown carry is, let's say $600. Now, if it's $600, here's what this person who wrote this book says. If I know that my worst drawdown is $600, okay, then yeah, that's right. It's a little larger. Most people wouldn't have that if they were taking smaller trades. Let's say it's $400. Okay. If I know my max drawdown is $400, this trader / mathematician says take that number and multiply it by 1.3. So now carry my max drawdown, if I multiply 400 times 1.3 is what? $624. So here's what he teaches. He says, number one, you have your growth in your equity curve. It's starting to pull back. Here's 400. Carry after $625 of pullback. Did I get it wrong? I'm sorry. 520. Forgive me. I got it wrong. I screwed it up. 530. After $530, George, you go from live or trading it in the Top Step Trader account. Right here, when you hit the minus 530 mark, Carrie, you know what you do? You're in sim mode. You're continuing to track your trades, but George, from this point forward, you're in simulation mode. So, in theory, Clancy, this can continue to fall, but your real equity curve will look like this. It'll plateau. Ah, there's that word again. When do you start trading live again? When do you start entering orders into the combine? His rule says wherever the valley is, let's say this is the valley, the bottom, the lowest amount. He said then you don't start trading live until it retraces 30%. So if you're down 530, 30% of that is $159. So Neil, if we come up $159, let's say $160. $160. When you get to this point, Carrie, he says mathematically the conditions favorable for your model exist again. And now, at that point where the blue line is, you're live, or you're actually tracking your Top Step entries. You're putting those entries into your combine. So what we're doing here is we're mathematically preparing for the inevitable drawdown and the inevitable plateau phase. So determine your max drawdown. You need at least 400 to 500 back tests to get a reasonable margin of error. For those of you who know what such thing is, you can perform a Monte Carlo analysis to find your max drawdown in that data set. And if you don't know what that is, email me, I'll tell you. And then establish 30% beyond that, because that's a statistical freak. We shouldn't be that far down, and if we are, a circuit breaker closes. Now, if you've done this right, you've already gotten money from this point because you traded your drawdown and you're all live, and this is all the bank's money here. But when you don't go back from sim to live, you don't go back into your combine until the model has retraced 30% from its peak to valley drawdown. Does that make sense, everybody? So if the highest it ever got was here, and the lowest it ever went was there, if it pulls back 30% of your max, you go. Now, what if it comes up, it goes through your 530, and Neil, it continues to drop down to 1,000, minus 1,000. Nuclear war in North Korea. Boom, 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 boom. Market just tanks. The author then says, your requirement is it must now come up $333 before you'll trade live, before you start putting your entries back into the combine. It is always 30% from peak to valley, whatever the lowest amount is. If it comes down and it kind of goes up 20% and keeps dropping, you don't trade live. The magic number is 30%. Now, that's hard to keep track of for me. I have, if you've not figured out by now, a short attention span. I like to keep things moving in my head. The second technique is the most simplified, but it embodies the spirit of what I'm about to show you here. So method number one, if I get hit by a bullet in the back of my head and I don't say another word, you can use this and you will survive the combine if you remember everything I've said up till this point. Your account will thank you if you're a privately funded entrepreneur or investor. Number two, I believe, is easier. And method number two says this: get your equity curve. I don't know why I'm yelling. I get really excited about this. Method number two, and again, this is in the book that you're all going to get. Everyone who registered today and clicks on the link I'm going to send you in a second. Equity curve, moving average. Equity curve, moving average. To do this, again, requires margin of error, if you can, with 400 to 500 back tests. It sounds like a lot, but it's not. You do 20 or 30 a day, in 20 days you're done. And you want to have a margin of error somewhere between 5 and 6%. Now, I'm going to draw a theoretical equity curve, and then I'm going to show you an example of this. Whoops. Okay, so let's say the equity curve does the following. Good equity curve, right? No, Gary. Jones, the author that I'm going to give you the book for, says this: apply an SMA to your equity curve somewhere between 10 and 20. Wait, what? You put an SMA on a trading chart. You don't put a moving average on an equity curve. Check this out. If you're doing it with a 10 or a 20, your moving average on your equity curve, if it's a 10 or a 20, is going to start to do this. Everywhere, let's say this is a 10-period moving average, and I'll show you how to do this in Excel in a second. Everywhere the equity curve crosses the moving average below, you go to Sim. You continue to track your trades, but you don't enter them in the combine. You don't use your live account. And then carry. Everywhere the equity curve crosses back above the moving average, you use your live account. And there will be points where it goes live, Sim, live. And then over here, you're in sim again. And then over here, you're in live again. Remember, Top Step doesn't want you to hit that lower level. They want you to know that you're risking their money when you do that. So when you employ this technique, do you see how farther it gets you to the goal? Because now, in reality, your equity curve doesn't look like that. It looks like this. It comes down, it goes flat, it comes down, it goes up, it comes down and goes flat. It comes down, it goes up. And Top Step sees this. Your wife sees this. Now, you will make, on average, less money when you do it this way. You will make less money. But when you want a live funded account, the person who's watching you goes, this guy's got it figured out. Because the other guy who's putting his quarter in the machine to get the live funded account, his account looks like this, Carrie, and they shut him off. And his account, Bill, went down in that drawdown, and they shut him off. Do you guys see the difference? Come with me over to this curve right here. And what I'm going to do is I'm going to right-click on this. This is a real set of trading results, back-tested results from a customer. And over here, you see where it says 25%? Carrie, I'm going to change that to the most aggressive, to 10. Now, when you have that, can you see how it's impossible to lose $1,000? Could you ever hit the Top Step threshold where they kick you off if you employ this technique? Yes or no? No. Okay, I'm going to blow it up. Let's zoom in a little bit. A lot of you are sending, a lot of light bulbs are coming on right now. Let's blow it up 200%. There is no way you can get thrown out of a combine if you do this. Okay, the worst that can happen is that Puritan work ethic kicks in and you go, I'm not making money. I'm not making money. But you already know that that's not what trading is. Trading is not losing money when the conditions are not acceptable for your model, not profitable, and surviving to the next growth phase. Okay, now let me show you a really bad model. Let's see if I can find it. I want to find an example of a really bad model. Here we go. Carrie, you see that turd? That's a turd. Now watch. Add trend line. Moving average. Period. 20. Hey. Now when I look at this, can you see what the difference is? I'll zoom it in. And I'm not sure how to stretch out equity curves here. Let me do this real quick. A lot of light bulbs just came on for a lot of people. I'm super excited. Okay, so here I'll stretch it out. Look, all of these times that you're below the moving average, look, were you in this drawdown? Did your account get hit, Carrie? If you were in sim from here to here, No. Your account went up, 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 and then down, and that whole span of time, you didn't lose any money. Now, this is a really bad trading system. Okay, you can see it. It just goes down and down and down. But look at where you were live, and then look at where you weren't losing money. Look at where you were live, and then look at where you weren't losing money. Can you see here how when the model was favorable to your conditions, you made money, and when it wasn't, you weren't losing it? Okay, so now you can be as aggressive or not as you want. Watch if I change this from a 20 period. Whoops. Watch if I change this from a 20 period to a 50. Do you see how there's less thought involved, everybody? Is there any way to get thrown out of a combine if you're following this technique? Everywhere I'm above the moving average, my model is making money. Everywhere that I'm above the moving average is when I'm live. Everywhere that I'm below the moving average is when I'm in sim or I'm not entering anything in to my combine. Top Step didn't see any of this. They saw a no trade day. What did Top Step see? Oh, look, he's making money again. Then you had a little bit of a drawdown, and then you disappeared. They don't see you anymore. He didn't trade. Why isn't he trading? Well, he's not losing money. He had a little drawdown. And they don't see any of those. The account doesn't see any of that. Everywhere you see a blue line is a trade that didn't exist. Everywhere you see a green line is a trade that existed. To get here, though, you need to understand everything that I've laid out. A drawdown is coming. Take advantage of it. You need to understand that an equity curve has a growth phase, a drawdown phase, and a plateau phase, which is the worst. You need to understand that your work ethic means SHIT to the markets. They don't care. The banks are pulling you into these stop runs because you're anxious about the fact that you haven't made money. Leverage the math of the model. If you know what your max drawdown is, don't start trading live until you're in it, because then you're trading with everyone else's money. Method number 1, 400 to 500 back tests. Have a solid system. If you don't have a system, email me. We'll talk. Understand what your max drawdown is statistically. Multiply the number by 1.3. That's your sim moment. Peak to valley, you're in sim. Retrace 30%. Top Step sees your trades again. Otherwise, you let it fall and you wait. Drawdowns don't last forever. Plateaus don't last forever. Growth phases are coming. You have to wait. Finally, system number 2, 400 to 500 back tests. Ideally, if you can't go that far, make sure you have at least 100. Deploy a 10 to 20 SMA, and then when you're trading, Top Step only sees your stuff when you're above the MA. And when you're below it, you're stealth mode. Nobody knows what happened. Where did Howard go? Where's Neil? What's he up to? Well, he had like a $200 drawdown and then it stopped. Then a week goes by and it's back up flush, and now you're +2, +3, +4, +$600, +$800, and then you go off radar for a while. Hey, what happened to Bill? He was doing really good. He's not losing any money. That's all I care about. Good job, Bill. All right. Any questions about that? Method number 1, method number 2 doesn't require anything but attention to the math.